Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and what a day! Today we had the S&Ps that had a very significant sell-off, down 113 points. You can see driving us back to the fire line pretty much in two swift sessions, all the way up from 2830 down into 2650. And these types of moves I know can strike you sometimes as maybe being a little bit scary, and especially depending on how you're positioned, rougher than some others. I think it's very important, however, to look at this and recognize that this is not the point to come in and get short. For the longest time, we've been working with a very low volatility type market, and today we saw that implied volatility come back in a huge way. Of all of these various labels I'm using up here, for the SPX, the only one that's really relevant right here that I'm speaking to is this IV percentile, which is telling us that the implied volatility in SPX is higher, or the highest it has been, in the past 52 weeks. So if you come in and think that this is the spot to get short, I actually think that this is the spot where you want to try to come in and sell a little bit of premium. Now, at the same time, I'm not going to rush in here blindly and start doing it, but I'm going to start nibbling on some ideas, and you can customize this risk in a lot of different ways. But one strategy that I have found to be pretty solid in Microsoft is looking at ratio spreads, or just looking at the idea and saying, well, I think that Microsoft is going to hold $85 over the course of the next 11 days as we get into this next monthly expiration, because of course this is where you'll see a lot of that implied volatility. So if you come in and say, I think that Microsoft is going to hold 85 within the next 11 days, one strategy you could look to do would be to sell two of the $85 puts and then buy one of the 87s. Because if you sell the 285 puts and it comes back down into 85, you're probably going to be sitting there sweating it. But if you can sell two of the 85s and then buy one of the 87s, the entire transaction goes at a credit. Now, you want to be very careful with this way of thinking because it does involve a naked put option. But when you look at this through the risk analysis graph, this kind of helps paint that picture. Just on a one lot, once again, make sure that you're comfortable with doing a naked type strategy. But the benefit of this is that if you bleed down into 85, that's where you can actually maximize your profit. If we do start to bounce, or even if the volatility comes out of these a bit, you will see this trade mature for you. And this is one place to look at it. Now, another is Apple, where you've got the same thing. Your IV percentile is sitting at 95.5. So I think you're getting down into a vicinity where you might want to consider trading Apple to the long side. If I tried to consider a very similar trade, I would look at it and say my estimated move over the course of the next 8 days, or the next 11 days, is about $8. So could I do this at 150? This isn't perfect off the range, but you can see how you're trying to work a bounce and just saying if I sell two of these and then buy one of the opposing options, this one goes for a smaller credit, and of course a lot of this will depend on where the market is trading when it is open. Trying to adjust these spread prices while the market is closed just gives you a place to consider the idea. If you can take in this trade for a credit, that would be the place that you'd like to do this. They're going for about, and just to help show my point here, I'll buy the 152. And they're at the, let's just say that for sure you could get this for something like an 85-cent credit tomorrow. If you analyze this, once again, be careful with these, because if the market really does continue down, you've got to know what you have on at risk. But I just think this is a very effective way of selling some out of the money premium, buying a little bit to protect yourself if it dribbles lower, and then if we get the bounce, you're still looking good. If the markets continue to get hammered, these will be positions you want to manage the risk on and potentially hedge, but I think it will be a good strategy in the next 3 to 6 weeks. So I hope that's helpful, and we'll see you at the next free video.